Welcome to the Pro Ticker Deep Dive.
It is Monday, February 9, 2026. And I have to say, looking at the sheer volume of filings, motions, and analyst notes on the desk today, the atmosphere out there is electric. It is charged.
Charged is the right word. It feels like the air before a thunderstorm, doesn't it? We are looking at a day defined by these massive, high-stakes dramas.
Absolutely.
We're talking about legal battles between absolute titans of industry. We're talking about massive stock rebounds that can, make your head spin. And we were talking about shifting timelines for humanity's expansion into space.
It really is one of those days where the headlines tell one story, but the details, the fine print, the legal filings, the analyst notes, they tell a much more complex and, frankly, a much more interesting story.
Exactly. And that is our mission today. We are going to look past those bold fonts and understand the strategies playing out right now.
The real game behind the game.
We've got a David versus Goliath brawl, though. I mean, David is still a multi-billion-dollar company involving Alphabet and Autodesk. We've got a massive 15% surge for AppLovin that is purely a reputation play. And we have a lightning round of market pulses that are going to keep us on our toes.
We certainly do. There's a lot to get through.
So let's unpack this. I want to start with the courtroom drama because this is, it is straight out of a spy novel. We are looking at Alphabet Google being sued by Autodesk.
That's right, over a trademark.
And the center of this storm is a single word: flow.
It sounds so peaceful, doesn't it? Flow. It evokes ease, seamlessness. But right now, it is the center of a very, very aggressive trademark war.
It really is. So Autodesk has filed a complaint in federal court in San Francisco. And the gist is they claim Google is improperly using the Flow trademark. But this isn't just about a name on a T-shirt. This is about the future of AI and entertainment.
Precisely. This is about who owns the tool set for the next generation of creative content. If we look at the filings, the stakes are incredibly high because of the sector. Both companies are using this name for AI-powered software, specifically targeting the creative industries, movies, TV shows, video games. This is the engine room of modern media. It's where billions are made.
Okay, let's look at the timeline, because this is where Autodesk's argument really starts to take shape. According to the complaint, Autodesk has been using the name Flow for their visual effects and production management tools since September 2022.
Which, in the timeline of AI development, is actually quite established. 2022 is practically a generation ago in tech years. They have users, they have brand recognition in that very specific niche.
Exactly. They've been in the market, they've been building the brand. And then here comes Google. In May 2025, just last year, Google launches its own product, also called Flow.
And not just also called Flow, but also targeting those same creative professionals, the same studios, the same artists, the same production managers.
But here's where it gets really, really interesting. This isn't just a case of, oops, we picked the same name. Autodesk is alleging something much more calculated. They claim that Google explicitly told them, in conversation, that they would not commercialize their Flow product.
That is the betrayal narrative that is so central to this lawsuit. It suggests bad faith. It suggests that Google lulled Autodesk into a false sense of security while secretly preparing to launch a direct competitor.
It's one thing to compete, it's another thing to say, don't worry about us, and then compete.
It changes the whole complexion of the case, legally, and from a PR perspective. It paints Google as a predator.
And the preparation, oh man, this is my favorite part, the Tonga twist.
The Tonga maneuver. This is fascinating from a legal strategy perspective. It's brilliant in a Machiavellian sort of way.
So Autodesk alleges that Google engaged in what they call a stepping stone strategy. To get the trademark, Google didn't file in the U.S. first. They filed to trademark the name of Flow in the Kingdom of Tonga.
Right. And for listeners who aren't trademark attorneys, this might seem completely random. Why Tonga? Why an island nation in the South Pacific?
Yeah, were they planning a beach launch? A big luau for their new software?
Unlikely, no. This is actually a known, albeit controversial, legal loophole. Under international treaties, like the Paris Convention, if you file a trademark in one member country, you can use that filing date as your priority date in other countries, including the U.S., as long as you file within 6 months.
So it's a placeholder. It's like putting your coat on a seat at the movie theater.
It's a silent placeholder, and the silent part is key. The U.S. Patent and Trademark Office database is easily searchable. It's online. If Google files for Flow in the U.S., Autodesk, who is monitoring that name, gets an alert immediately.
Right, alarms go off.
Exactly. Red flags everywhere. But the trademark registry in Tonga, it's not online in the same way. It's not easily searchable by competitors running automated keyword scans from Silicon Valley.
So they hide the paper trail, they bury the lead in a place no one is looking.
Exactly. They file in Tonga to secure the date, proving they claimed it on, say, January 1st. But they do it in a jurisdiction where Autodesk is completely unlikely to be looking. It keeps their plans secret until the very last minute.
That is devious. I kind of respect the strategy, but I also see why Autodesk is absolutely furious.
It's a strategy designed to ambush, and that's exactly what Autodesk claims happened. Google used that Tonga application as a stepping stone to then seek protection in the US, effectively trying to bypass Autodesk's prior usage by claiming this earlier international priority date.
It's like they're trying to cut in line by saying they were waiting in a different line on another continent that nobody knew
So that's a
existed.
perfect analogy.
Yeah.
And then they didn't just quietly release it. They didn't just put it up on a website. They went to the Sundance Film Festival,
The biggest stage for independent film in North America, maybe the world.
the heartland of Autodesk's target demographic.
Right, Google is there promoting Flow heavily. They've got booths, they're doing demos, and Autodesk is saying, hey, that's our crowd. Those are our customers. You can't just show up at our party wearing our name tag.
And that creates the core legal argument. Consumer confusion. In trademark law, that's the whole ballgame. You have to prove that a consumer would look at Google's product and mistakenly think it's associated with Autodesk.
And how could they not?
Well, that's the argument. When you have two products, both called Flow, both using AI, both targeting filmmakers, and they're both being marketed at the same film festival, the argument for confusion is very, very strong.
It seems like a slam dunk on the confusion front, but Autodesk is taking it a step further. They are using the bully argument. They're saying Google's actions are designed to delay competition and use their sheer scale to overwhelm Autodesk's product.
And this is where the disparity in size becomes a weapon.
We're talking about a multi-trillion-dollar company.
Right. It's the might makes right approach. Even if Autodesk used the name first, Google has the resources, the marketing budget, the platform integration to just flood the market with their version of Flow until Autodesk's version is drowned out, forgotten.
So even if Autodesk wins the legal case in 3 years, they might have already lost the market.
That's the fear. That's why they're suing now. Autodesk is seeking unspecified compensatory and punitive damages, but really they want an injunction. They want Google to stop now.
So we have the legal battle. It's fascinating. But how does this translate to the scoreboard? Let's look at the financials, because we have a fascinating comparison table here between Autodesk, ticker ADSK, and Alphabet, ticker GOOGL.
This is where we see the David versus Goliath dynamic in hard numbers. It's stark.
Okay, looking at the tape for today, February 9th, 2026, Alphabet is trading at $326.79. Their market cap, hold on to your hats, is $3.91 trillion. With a T.
A colossus. It's a number that's almost impossible to comprehend. It's bigger than the GDP of most countries on Earth.
It really is. And Autodesk, trading at $241.70 with a market cap of $50.96 billion.
Now, let's be clear. $50 billion is a massive, incredibly successful company by any normal standard. They dominate their fields. But next to $3.91 trillion, it's a rounding error. It's about 1.3% of Google's size.
That frames the litigation perfectly. Google can afford to litigate this for a decade. Their legal budget is probably bigger than Autodesk's R&D budget. The question is, can Autodesk sustain that fight?
That's always the question in these asymmetric battles.
But here's the surprise. When we look at Wall Street's take, the analysts are actually leaning towards the little guy, at least in terms of growth potential.
They are. And this is the part that I find most compelling.
Okay, so both stocks have a strong buy consensus rating from analysts, and both have a perfect 10 SMART score, which is that quantitative rating of their potential to outperform.
So on the surface, Wall Street loves them both. No red flags.
But look at the upside potential. The analyst price target for Autodesk is $373.10. That implies a massive 54.4% upside from where it is today.
That is huge growth. That's the kind of return investors dream of.
It's enormous. Meanwhile, Google's target is $376 or 63 cents, which is, still great, but that's only about a 15.3% upside.
Only 15%, which for any other company would be fantastic.
Well, yeah, but compared to 54%, it's a huge difference in expectation. So why? Why is the David favored for growth here over the Goliath?
I think it comes down to focus versus scale. Google is everything to everyone. Search, ads, cloud, AI, autonomous driving, YouTube, Android. It's an empire. But because it's so massive, it's hard to double the value of a nearly $4 trillion company. The law of large numbers eventually kicks in.
Right. To move the needle on Google, you need a trillion-dollar idea, another search engine.
Exactly. But Autodesk, they dominate a very specific high-value, high-margin niche: architecture, engineering, and now, increasingly, AI for entertainment. They're a specialist.
And the specialists can grow faster.
Much faster. If their Flow product or their broader AI suite becomes the industry standard for the next generation of filmmakers and game developers, that $50 billion market cap could double or triple much faster than Google's could. The addressable market is smaller, but their potential to capture it is greater.
So the analysts are seeing Autodesk as a coiled spring, ready to pop if they can just defend their turf.
Yes. And regarding the lawsuit, does this threaten Google's stock? Likely not. A trademark dispute, even a big one, won't dent a $4 trillion balance sheet. It's a line item. But for Autodesk, defending this territory is existential.
Right.
If they lose the name Flow and the brand equity associated with it, that hurts their growth narrative significantly.
So Google is fighting for a product name. Autodesk is fighting for its future identity in the AI space.
Well, that's a fair way to put it. It's a battle for a specific hill that is much more important to one side than the other.
Whatever happens, I'm never going to look at a trademark filing from Tonga the same way again.
It certainly adds a layer of intrigue to the paperwork, doesn't it?
It really does. Okay, speaking of intrigue and massive stock movements, let's pivot to our second big story of the day. AppLovin, ticker symbol APP.
A very different kind of drama here. Not in the courtroom, but in the court of public opinion and the market.
We are seeing AppLovin stock soaring today, up 15% in a single session.
Which is a massive move for a company of this size. This isn't some penny stock. This is a significant re-rating by the market, happening in a matter of hours.
And the catalyst is, well, it's a retraction. A financial publisher has formally withdrawn claims that AppLovin was involved in illegal activities.
And not just any illegal activities. Specifically, money laundering.
The dreaded M word.
It's the scarlet letter for any company that touches money, especially in the tech space.
Yeah. I mean, you throw money laundering at a fintech or mobile tech company, and investors run for the hills. They don't wait for the details. They sell first and ask questions later.
It's toxic. Allegations of financial impropriety, especially something as serious as money laundering, strike at the very core of a company's investability. It's not just about a bad quarter. It's a fundamental question of, is this business legitimate? It creates existential risk.
So evidently, a report came out making these claims. The stock likely took a huge hit when that happened. And now, today, Feb 9, the publisher says, our mistake, we take it back.
And the market's reaction is instantaneous and ferocious. That 15% jump is what we call a relief rally.
It's like the stock was holding its breath underwater and just came up for air.
Exactly. The illegal activity overhang, that cloud of suspicion, is removed. The uncertainty is gone. And all those investors who liked the fundamentals, the revenue, the user growth, the profit margins, but were scared off by the legal and reputational risk, they are flooding back in.
It really shows how fragile reputation is in this market and how much it's worth. 15% in a day is the price of a clean name.
It is. And it highlights the short report phenomenon we've seen so much of in the 2020s. A negative report comes out, often from a short seller or a niche publisher, making bombastic claims. The stock tanks. The sellers make a profit. Then, weeks or months later, if the claims don't stick or are retracted, you get this violent snapback.
But 15% in a day? That implies the market is ready to forgive and forget immediately. There's no lingering doubt.
It suggests two things. First, that the underlying business is strong. The market is effectively saying, okay, the fundamentals we liked before are still there. The story was false. Back to business. But second, it also raises a scary question about the power of information, or myth information.
Right. What if they hadn't retracted?
Exactly. What if the publisher had just gone quiet? AppLovin could have been in the penalty box for years, spending millions on legal fees and PR to clear its name, with that cloud hanging over them the entire time.
It's a reminder to always, always check the source. And even then.
Even then, it's tough.
Speaking of checking sources, we have a lot of moving parts in the broader market today. I want to hit our Market Pulse segment and just kind of touch on these other stories that are bubbling up.
Let's run through it. A lot is happening.
We've got news from space, crypto, gaming, and autos. It's a real cross-section of the 2026 economy. Let's start with the stars. SpaceX.
Always making headlines. Elon Musk ensures that.
The news today is that SpaceX is pushing back the Mars landing timeline.
Again, this has become a recurring theme, hasn't it?
It has. But there's a pivot. The focus is now shifting to the 2027 moonshot.
This is a fascinating strategic realignment. For years, the narrative has been Mars, Mars, Mars. The red planet was the prize. It was the grand vision.
And now it's the moon. So is this a failure? Is this them admitting Mars is just too hard?
I don't think so. I don't see it as a failure. I think it's a reality check. Mars is incredibly hard. The logistics, the life support systems for a multi-year journey, the radiation, the transit time, it's an order of magnitude more difficult than the moon.
And the moon is, well, it's not easy, but it's closer. It's a 3-day trip. It's a proving ground.
And a much more logical stepping stone. It feels like they are managing expectations now. Investors and the public love a deadline. Mars by 2026 sounded great back in 2020, but now that we are actually in 2026...
The rubber meets the road, or the rocket meets the launch pad.
Precisely. The engineering realities are setting in. By pivoting to a 2027 moonshot, they give themselves a tangible, achievable, and still incredibly exciting milestone. It keeps the momentum and the excitement alive without the constant disappointment of missed Mars launch windows.
So it's smart corporate communications, even for a private company. Manage the narrative.
Absolutely. The moon is still inspiring. Landing humans on the moon for the first time in over 50 years, that's a huge win.
Okay, from the moon to the death zone, let's talk crypto.
Oh, this sounds ominous.
Ethereum, ETH. The headlines are screaming about the $2,000 death zone.
That sounds terrifying. You don't want to be in a death zone.
Not at all. And apparently the driver for this is that ETF panic is peaking.
Ah, okay. This is classic crypto volatility. Here we are in 2026, and the market is still wrestling with regulation and institutional adoption. The death zone usually refers to a critical technical and psychological support level on a price chart.
So if it breaks below $2,000...
If it breaks below and stays below, technical analysts will predict a free fall. They'll see it as a major breakdown in market structure, potentially leading to a much deeper sell-off. Psychological cliff.
And the ETF panic, what's that about?
It suggests that maybe the inflows from those exchange-traded funds we were all so excited about a couple of years ago, maybe they're turning into outflows. Remember, the ETFs were supposed to bring stable, institutional money into crypto.
It's smart money.
Right. But if that money gets spooked and starts heading for the exits, it creates immense selling pressure. This is a real test of conviction for the crypto faithful. Is this the bottom, a buying opportunity, or is it the start of another crypto winter?
Hold on tight if you're holding ETH today. Okay, let's switch gears to something a bit more fun. Gaming. Microsoft.
MSFT. Always a bellwether.
The stock is rising alongside reports regarding the next Xbox. And the rumor mill is churning. The snippet we have just says it will be a gaming something. But the buzz, the speculation, is all about a handheld.
A hybrid device. Something that can be docked to a TV, but also taken on the go.
Like the Nintendo Switch? Or the Steam Deck?
That seems to be the direction the entire industry is heading. Look at the shift in gaming habits. People want their AAA high-fidelity titles, but they want them on the bus, on the plane, in bed. The era of being tethered to a television is fading for a lot of younger gamers.
And Microsoft has the ultimate weapon for that, Game Pass.
Exactly. That's the key. If they release a dedicated, powerful handheld that plays Game Pass titles natively without having to rely solely on cloud streaming, that is a killer app. That is an ecosystem lock. It explains why the stock is ticking up just on the rumor.
So hardware is hard, but if they crack the handheld market?
They could own the entire gaming experience for millions of users. It's interesting to see them doubling down on hardware when everyone thought they were going to go pure cloud a few years back.
Well, the cloud is the future, but hardware is the gateway, right? You still need a device to access the cloud. Microsoft wants to own the device too.
Control the hardware, control the software, control the subscription. It's the full stack.
Okay, let's come back down to earth. The automotive sector. And it feels like a tale of two cities here, a real split.
It really does. The old world and the new world are both struggling in different ways.
On one hand, we have General Motors. GM, the headline is, well, it's grim. Canadian politicians call for tax relief on General Motors severance packages.
Ouch. That is not a headline you ever want to see.
Reading between the lines here, you don't talk about severance tax relief unless there are massive, widespread layoffs happening or about to happen.
Exactly. This implies plant closures or significant workforce reductions are underway. It's the ongoing struggle of old auto. They are trying to transition to EVs, trying to modernize their factories, but they are weighed down by decades of legacy costs and a massive workforce structure that was built for the internal combustion engine era.
It contrasts so sharply with the tech optimism we were just talking about with Microsoft, or even the rebound found in AppLovin.
It does. While software companies are fighting over trademarks for next-gen AI and launching new gaming platforms, legacy manufacturing is fighting just to survive the transition. It's a painful process.
And it's not like the new auto is having a great day either. Li Auto, the Chinese EV maker, ticker LI, is falling today, and JP Morgan is involved.
That usually means one thing. A downgrade or a negative analyst note has come out.
So the EV sector in 2026 is still incredibly volatile. The gold rush is over.
It's very volatile.
Yeah.
It's no longer the growth at any cost, darling. It was 5 years ago. Now, investors demand profitability. They demand consistent delivery numbers. If Li Auto is slipping, it might be a demand issue in the competitive Chinese market or a margin compression issue from rising costs. The easy money has been made.
Tough day for cars, new and old. But let's end the pulse on a slightly higher note. Semiconductors. AMD.
Advanced micro devices. My favorite soap opera.
The headline says AMD stock has strong potential in 2026 despite an early setback.
That's the resilience theme of the day again, isn't it?
It is. The chip war continues. It's relentless.
It never stops. AMD is in a constant three-way slugfest with NVIDIA and Intel for dominance in CPUs, GPUs, and especially now, AI accelerators.
So what do you think this early setback could be?
It could be anything. A minor delay in a product launch, a slightly missed earnings target last quarter, a big customer choosing a competitor for one product cycle. But the key phrase is the second half of that headline, strong potential.
That tells me that analysts believe in their long-term roadmap.
Almost certainly their AI chip roadmap. In 2026, if you aren't winning in AI silicon, you aren't winning, period. The fact that the long-term outlook is strong suggests that whatever their next-generation chip is, Wall Street believes it's going to be competitive against whatever NVIDIA is putting out.
So don't count them out just yet.
You never, ever count Lisa Su and AMD out. They have come back from the brink too many times. A setback for them is just a setup for comeback.
Okay, wow. We have covered a lot of ground, from the beaches of Tonga to the courtrooms of San Francisco, from the launch pads of SpaceX to the trading floors reacting to money laundering retractions.
It's a dense day. Every story has layers.
So what does this all mean? If we synthesize this, if we zoom out, what is the theme of February 9, 2026?
I think the theme is resilience and territory.
Explain that. I like that.
Well, look at every story we talked about. Look at Autodesk. They are defending their territory, their name, their brand, their identity in the creative AI space against a giant. They are being resilient in the face of Google's overwhelming scale.
Right. They're drawing a line in the sand.
Exactly. Then look at AppLovin. They were attacked. Their reputation, their corporate territory was carpet-bombed with a massive accusation. But today, they're recovering it. That 15% bounce is pure resilience in action.
And SpaceX. How do they fit?
They are redefining their territory. They're saying, okay, Mars, that territory is too far for now. It's too hard. We are going to claim the moon instead. It's about understanding the battlefield, adapting, and fighting for the ground you can actually take. It's strategic resilience.
I love that. And for you, the listener, I think the so what here is pretty powerful. What's the takeaway?
It is. I think it is.
Today really teaches us that headlines are often just temporary barriers. They're noise. A lawsuit can be filed, a Mars landing can be delayed, a terrible accusation can be made.
But the market, over time, the market eventually finds the truth. It returns to the underlying value. The perfect 10 smart score of Autodesk is what matters in the long run, not the bully tactics of a competitor. The strong fundamentals of AppLovin are what matter, not the retracted story.
So you have to have the stomach to ride out the headline risk. You can't panic.
You have to separate the signal from the noise. That's the entire job.
Before we sign off, I have a thought that's going to bug me all day. Two thoughts, actually.
To them.
First, if Google is willing to file trademarks in Tonga, literally using an obscure island nation to hide its strategic moves in AI, what other jurisdictions are currently hiding the next big tech product launch?
That is a great and slightly terrifying question.
I mean, is the patent for the next iPhone hiding in a filing cabinet in Liechtenstein? Is the design for the next Amazon drone sitting in a registry in Vanuatu? It makes you wonder what's happening in the shadows.
It's very possible. The global legal system has plenty of dark corners for corporations to operate in.
And my second thought, regarding AppLovin, the claims were withdrawn and the stock popped. Great news for them. But in the age of AI-driven finance, where algorithms read headlines in milliseconds and can dump millions of shares before a human even sees the news, how much damage can a single false accusation do before the truth even has a chance to put its boots on?
A lot. A terrifying amount. And that's why critical thinking and deep dives like this are really the only defense an investor has.
Keep looking beneath the surface, everyone. There's always more to the story.
Always.
We'll catch you on the next deep dive.